Welcome. My name is Mark Dupuis. I'm one of the principals here at Simple Acquisitions, where we partner with private individuals like you to acquire properties that deliver great returns. One of our goals is to communicate information about the various aspects of real estate assets so you can be better armed to make informed decisions about investing in this new economy. Property analysis is just one of the critical parts of buying real estate. Understanding what numbers to look at and how to interpret them properly is so important in your buying decision. In this video series, I'm going to walk you through the various stages of analysis. Today, I'm going to show you how we do an initial analysis of a property. This is something that my partner Amanda does when we first receive a property to determine if it's of interest to us. Actually, we're always interested in acquiring properties. It's just a matter of determining at what price. This preliminary analysis is a 10,000-foot view of the property. All it's designed to do is to give me a trigger to analyze this further if it's warranted. We are forwarded many properties that never make it past this step, and we certainly don't want to waste anybody's time on a property if we see we are too far apart on the numbers. First, let me set your frame of mind. The assets that we chase typically require some kind of injection of either capital or needs a strategy to revitalize it. Current owners either don't have access to or are not willing to provide that. So documentation is more times than not a little lacking. Property owners also do their best to try and place their asset in the best possible light, and sometimes stretch the truth a little bit. Ever heard of a pro forma report? Well, this is when owners give us documentation that is based on projected income and expenses, and not on the current numbers, to help make it more appealing to buyers. We don't base our purchase price on future numbers, but on current numbers. So it's our job to analyze the property thoroughly and find those discrepancies and bring them to the owner's attention during the due diligence period. So where do we get these properties? Good question. We run ongoing mailing campaigns, so soliciting current apartment owners. We have alliances with realtors, property managers, and wholesalers who all bring us properties, and we also attend auctions to acquire some good properties as well. It might surprise some of you to hear that at an auction held in early May of 2014, somebody in our group bought a house for $800 that can be rented for $526 a month and was valued at $26,000. That's the kind of things that aligning yourself with us gives you access to. Now, Properties will usually have varying degrees of documentation, from none at all to a full-blown prospectus. Documentation we receive from all these sources is sent to Amanda to run this PAR analysis, which is to determine if the property from day one is worth pursuing.
Let's move to the analysis spreadsheet we use for the basic analysis. The top section of the spreadsheet contains some basic property information, such as name, asking price, number of units, strike price, and the name of the person who brought it to our attention. The numbers you'll see in this video are from an actual property we analyzed while I was living in Kernersville, North Carolina. And I still think that property could be a nice property to add to our portfolio. Let's begin with the income section. In this particular case, we were provided an average income of $449 per unit, which is vague, but good enough for this stage of our analysis. The box on the right allows us to enter the various apartment types and the rate for each of those. Of course, in this case, they are all one bedrooms and all at the same rate as well. So this is an easy one. Once the number of units and the unit price are entered, the spreadsheet automatically calculates the monthly and yearly incomes.
Now, before we go any further, let's talk about unit mix. We usually like to see a mix of units and not all one bedrooms or all two bedrooms. With that said, in some areas, having all units the same works just fine. It all depends on the area and how the property will be marketed. If we do have a mix, we like to see twice as many two bedrooms as one bedrooms and just a little sprinkle of threes. This is just to make sure the tenant mix is appropriate. One bedrooms typically have single people, where three bedrooms have families with kids, so they don't usually have the same type of lifestyle. So we try to purchase things that make sense in that respect, which will save us some possible headaches down the road.
To continue with our income section, you'll notice the income in the red cell is lower than what we calculated in our box to the right. That's because we build in safeguards whenever possible when analyzing a property. So we use only 90% of the income to simulate a vacancy rate of 10%, even though the market vacancy rate at the moment is 5.4%. And yes, even if the property is currently occupied at 100% and has been for years. The next cell is for laundry income, if there is any. In this case, there is none. I suspect the owner rolled up all his income into the $449 per unit income number, because I know there is a laundry facility there, but there was no income reported. Something to definitely dig deeper into when we get to that point. So the total rental income, which is simply the rents and the laundry incomes, added together in our case is $174,571.20. Now, for the expenses. At this early stage, we use a market-specific expense rate for all properties. We have enough market knowledge and dealt with quite a few properties that allows us to use a given rate for our markets that's pretty accurate. For the Triad area, we use 45%, or $78,557.04 in this particular case. Obviously, if we decide to proceed with this property, we'll dig deeper into all these numbers to get precise operating expenses. The objective of determining the income and expenses on any property is to determine the net operating income, or NOI. Everything we do to any property is done in order to drive the NOI. That amount here is $96,014.16 and is what we need to determine the value of this complex.
Now, we're getting into a real commercial aspect of real estate, the cap rate, or capitalization rate. This is the number that specifies the return of a specific asset. For instance, if you were able to generate $50,000 from an asset that cost you $500,000, the cap rate is 0.10 or 10%. We use this to compare this asset to others in the marketplace and to help give us an indication of the stability of the asset. The formula to determine cap rate is the NOI divided by the purchase price. In our example, that would be $96,014.16 divided by $1,135,000, which is 0.085 or 8.5%. As an investor, you want to know what the cap rate is in your market in order to compare the various complexes that are available. Cap rates usually have a range based on the class of asset. For instance, in Charlotte, North Carolina, the cap rate for an A-class building ranges from 5 to 6, B-class assets range between 7 and 8, and C-class anywhere between 9 and 12, and sometimes even higher. So what does this number really tell us? I think the best way to help everybody understand cap rate is to show how it relates to two separate complexes. Our two make-believe 36-unit complexes were built in the same city at the same time by the same builder, and for the sake of argument, the land value and operating costs are exactly the same. Once completed, they were able to be rented for the exact same amount, $1,000 per unit per month. However, one is a 6 cap, while the other, identical building, is an 11 cap. Right away, this should tell us a few very important things regarding these buildings. First of all, the 11 cap building is probably in an area that's not as desirable. And more importantly, the 11 cap building's income will be more unstable, which leads to what is really the big killer when it comes to real estate rentals: turnover. Because of those two factors, the exact same physical structure in the same market is worth less. If we use the cap rates and determine the value of our fictitious buildings, the 11 cap building is worth $2,160,000, while the same exact building across town is worth $3,960,000. Of course, I skewed these numbers by making land, building, operating costs, and income the same, which is not really realistic. But I wanted to eliminate all other elements just to show the use and effect of cap rate on assets. This will become very important later on when we implement some of our strategies, and you're really going to like what we're going to see.
Now that we've determined our cap rate, we can calculate the value of our asset. The formula to determine value is NOI divided by the cap rate. So in our example, $96,014.16 divided by the 0.085, which comes out to $1,135,000, which makes me assume his realtor really knows about cap rates. The debt service section that we see in our spreadsheet is where we put in the mortgage information. And all I really do here is use a mortgage calculator online to determine what the payments will be for a debt of 70% of the purchase price. So in this case, $794,500. What I will do for the interest rate is use 5.9%, since we are currently enjoying lower than normal rates at this point. But when things get back to normal, that will change. So we want to make sure we're still cash flowing when that happens. I also use 25 years on the term. Whether we end up financing at that term or not is irrelevant. We use this to put in a buffer, so if we can get a 30-year note, that will bring our payments down, then we're cash flowing a little bit better, and that's always a good thing. So using these numbers, our monthly payment will be $5,070.72, or $60,848.64 for the year. And finally, the bottom section of the spreadsheet, this is where we look at the overall performance of the asset. The cash after debt service obviously is the income this asset produces in the first year of operation after all expenses and servicing the loan. In this case, $35,165.52. The cash ROI, year one, or cash return on investment cell, tells us what the return is on a percentage basis for the first year in operation. In this case, 10.3%. Keep in mind for the moment, I'm using the asking price, so this will be much better when we purchase because we pay much lower than the asking price. I can guarantee you that. That number will increase as we move forward with rent increases and introduce the improvements we're planning for this asset. When analyzing properties, we target assets that have a 12% return from the start. We're pretty good at finding discrepancies and usually end up closing on the asset at a lower strike price, which increases our return. But for us to start to investigate and do all the due diligence required, we like to see 12% to start. TROI over 5 years, or total return on investment over 5 years. This is the percentage return we achieve over a 5-year hold period. If a particular project was different, like say a flip, we'd adjust that to be the appropriate length, or remove it altogether, depending on what is appropriate. But we're looking for long-term cash flow, so we'll look to keep the existing financial model in place for 5 years. The TROI number takes into account the 4 ways we make money in real estate. The first one we've already talked about, the NOI, or the cash flow from the rents. For this spreadsheet, we just increase the rents 2% every year and use the same 45% for our expenses. The next way we make money in real estate is the appreciation. How much will this be asset worth in 5 years? For our purposes, I use a 2% increase every year of our 5-year period. The third way we make money in real estate is depreciation. Depreciation is the best thing when it comes not only to real estate, but to investing. It's a non-cash deduction that will most likely allow us to earn all our cash flow tax-free. The IRS allows us to say the physical building part of our asset is worth less every year since wood, brick, mortar is getting used, so they give us a tax break for that. This is an accounting calculation that I leave for the accountants, and therefore don't use it at this level. I recognize that it's there, but can't really put a number on paper. And by not putting a number down when analyzing assets, we always know we've got a bit of an extra return on our investment. I'm just trying to be conservative again with everybody's hard-earned money. And finally, the amortization. This is basically the amount in which we would have paid down the debt on the property at the end of the 5 years. And in our current business model, we work hard to try and get all our investors' money back within that time frame, putting you in a situation where you are still invested in our project, but without having any of your own cash invested. So basically earning infinite returns. So for this specific case, the TROI is 63%, which is a 13% return per year. A very important thing to keep in mind is this return is only using 90% of the income, with a 2% increase in rent and appreciation, and doesn't take into account any of the changes that we'll bring to the complex or any of the accounting benefits we'll also receive. It's our ultra-conservative way of looking at an asset to determine if we're going to proceed to the next step. And the final row in this section is the DSCR, Debt Service Coverage Ratio. Basically, is the amount of money available to pay the loan. Banks these days like to see that number at 1.25 or greater, which just means they are that much more likely to get paid if there's a lot of surplus once we collect the rents.
Let's look at the projections for this project. Vendors don't just lay out deals for investors to invest in. Deals are created, so we look at all facets that surround an asset before we purchase it. It may be something outside of the asset itself that makes us interested in the moving forward. And oftentimes, the initial offering price is not what we end up purchasing the property for. So we, in essence, create the deal when we make the offers that we make.
I added this section just for the purposes of showing some more realistic numbers. I did some research on the internet in January 2014, looking for rent increases in the Charlotte and Greensboro areas of North Carolina, and found it ranged anywhere from no increase at all to 23%. When we originally received the offer memorandum for this property, we didn't have much information. However, we did pursue this property, so I can tell you now that the vendor became friends with his tenants and found it hard to increase their rents. So they are much lower than market rents and could probably absorb a higher than usual increase. So if we use a 5% rent increase instead of the 2%, the net effect is the overall return is now 114% or 23% per year. If we look at the increase in the value of the asset, it makes gains of over $161,731. Again, this is simply by increasing the rents 5% every year.
So, to close out, based on these numbers, Amanda would forward this particular deal to me in order to perform a more in-depth analysis. If you're curious to see what the next step of analysis we perform looks like, check out the underwriting template video series, where I'll break down all aspects of this deal into much more detail. If you'd like more information or would like to see how getting involved in real estate can benefit you, drop us a line. Our contact info, along with details on how to increase your financial knowledge, can be found on our website at www.simpleacquisitions.com. Now is a great time to invest in real estate. Don't delay in making your money work harder for you. Remember, real estate doesn't have to be complicated. With Simple Acquisitions, it's smart, secured, and simple. I'd like to thank everybody for joining me today, and I hope to hear from you all soon.